Joining me now is the founder of FNArena, Rudy Philippek van Dijk. And over the years, Rudy and I have discussed the illustrious Harry Dent. And Harry, of course, was on earlier in the show. First of all, Rudy, thanks for joining us. Let me kick off by asking you, are you a Harry Dent fan in his Armageddon scenario?
Peter, I must criticize you here. Why do you give so much attention to Harry Dent? Right? I can only hope that I'm allowed on your program because I'm less incorrect as many times than he is and has been. He was wildly enthusiastic in the late 90s, and that proved to be wrong. And then after that, he went wildly bearish. And let's be honest, apart from the occasional bear market this market runs into, he's been incorrect ever since.
Yeah, certainly you have often underlined his accuracy problem. He currently is arguing that the next leg down will be bigger and scarier than the last one. What do you think? Do you think a second leg down is likely, and if so, will it be of the same or lesser magnitude or even greater?
It depends what is the origin, what's the source, but I would argue at this point in time, I can see the dangers. There's a lot of debt in the world. Central bankers are using their balance sheet to prop up economies and financial system. I can see all that, but it would appear at this point in time that the central bankers, including the Federal Reserve, have managed to calm down a lot of the risks that were hanging over this market earlier this year. And at this point in time, unless we get something from left field, at the moment, I don't see it.
Yeah. Okay, let's move into what you are seeing. And one thing that a lot of Australians, people who followed you in the past, are really upset about the banks losing their passion for paying dividends. What do you think the banks are the banks a good buy for a long-term investor, really?
I hope that people who are in the banks or are looking at the banks, I hope they're not blaming me, the messenger, over the years. I have nothing to do with this. But all things serious, I've been writing about dividends and banks quite a lot over the past few weeks. I think people have to realize that while they are now missing out on their dividends, and they will miss out, the deferred dividends are probably just not going to come back anytime soon. But also the recovery in those dividends will be slower than we are used to on the basis of past experiences. For example, in the previous bear market, and then I'm referring to 2008, 2009, banks had to cut their dividends, but they quickly recovered. And really, really quickly. The next year they were already back going up. That is, all else being equal, probably a much slower pace now. And I think if anything, people just have to reduce their forecasts here and their expectations. But having said so, there are a lot of alternatives available in the Australian share market. The banks are by far not the only ones who pay out the dividends. And traditionally, I would argue that the sweet spot of the share market is when industrial stocks offer between 4 and 4.5% in yield, and then obviously they grow so that becomes more over time. At the moment, I would say that sweet spot has fallen lower to maybe around 3%. That's because bond yields are lower and share prices have been priced accordingly. But there are still a large number of industrial stocks and alternative financials that offer investors between 3 and 4% and have growth under their belt and do not necessarily have to cut their dividends this year. So there are alternatives available.
Okay, now obviously you've dangled the bait in front of my viewers. The next part is to actually pull in the big fish. What are those companies? Name some names, Rudy Philippek van Dijk.
Okay. Amongst the stocks that I either own or they are on my radar or I have been writing about them to FNArena subscribers are the likes of Coles, Woolworths, Brambles, Amcor, Ansell, Car Sales, Iris, there are more, but that's already quite a handful. That's a dozen already. All of those industrials will offer you around 3-ish%, sometimes a little bit more, sometimes a little bit less, but none of them is probably likely to cut their dividends this year, and they're more likely to grow their dividends over the years ahead, which means when it comes to sustainable dividends with a favorable balance between risk and opportunity, these are probably in the sweet spot in the market.
So, and do you think that if we get the lucky scenario, Rudy, in the sense that the comeback of the Australian economy ends up being a little bit better than the doomsday scenario has looked over the last few weeks, if that's the case, do you think some of these companies that do reduce their dividends, they might reward you in terms of better capital gain over the next 12 months?
Oh, it's well possible. I mean, the irony for a sector like the banks is that I call it, you can manufacture growth by first cutting your dividend really hard, and then of course by default it becomes easier to start growing your dividends in the subsequent years.
Yeah.
And if the share market, for example, if the share market in a year's time or in 2 years' time has a positive view and has a positive sentiment ruling the market, then the fact that the banks by then will be likely be growing their dividends might be taken as a positive, even though they will come from a lower level. But the share market doesn't necessarily care about these things; they just look forward, and so the irony is, bad news this year might actually provide for good news either next year or the year after. That's unfortunately how the share market works, or maybe not unfortunately, maybe luckily.
Yeah.
Right?
That's your take on dividends. Let me just run through some companies in the past that have been, the Rudy Philippek Van Dyke destroyers, ones you really like, they've done well. I guess Invacare was one of your favourites. How's it going? How's it going?
No, Invacare. This is the thing. I mean, there's no such thing as a 100% reliability. Things change, right? And unfortunately, Invacare was for a very long time a very solid performer. But their expansion in the US, that didn't go well. They had to retreat from that. I have to say also, the more I found out about that sector in particular in recent years, the less I actually like that sector. I mean, let's face it, if you really want to go brutal on them, people are mourning and they're trying to sell them a product, and if they can, they try to upsell them as much as possible. Yeah, I like them a lot less these days, but I mean, that's the long and the short of it.
Okay.
Right?
Because you're a racy kind of guy, Babcock has always been a favourite of yours. What's your current position on Babcock?
I still like them. I still own them. I still think there's a lot more upside for them in store. And I mean, and a similar thing can be said, for example, for a company like car sales, which also is one of those sustainable, attractive dividend providers in the share market as well.
Now, one last one. We got a question on our webinar last week, and I instantly remembered. In fact, I've always loved your pronunciation of Monadelphous, but it was a great company there and did brilliantly well. And I noticed that your great website says it's about a 20% upside according to the analysts. But what's your view on Monadelphous? So, really, at this point in time?
Monadelphous is one of those questions that you have between, like, are you going to buy a fantastic house in a street or in a neighborhood that doesn't look that well? And that's the decision you have to make as an investor. See, I've over time decided that the sector of contractors and engineers, for me, is way too volatile and way too much risk, in particular in this type of the cycle. I mean, something to point out, for example, is that the sector analysts at Bell Potter have now been warning their clientele since February that this sector is prone for a lot of disappointment this year. So their advice is be extra careful if you buy any of the companies in that sector. And I would assume that Monadelphous would be amongst the few that probably stand out with less risk and less risk for disappointment, I think.
Okay. Rudy Philippek Van Dyke, it's always great to tap that wonderful 24/7 stock market brain of yours. Thanks for joining us.
My pleasure, Peter.